you have to look at your capacity, your ability to produce, and you have to look at all of your costs, and then look at how much you'll need to produce, provide, sell in order to break even. And that break even number is what we're going to be examining here coming up. And this is a simplified approach to breaking even, and Ken's going to talk about some other formulas or uses of this formula in looking at breaking even. So breaking even is the point of sales where a business profit or loss is zero. So it's that revenue minus expenses is zero. So they equal each other. Now, the reason this is an examination of the numbers is because some expenses are fixed and some are variable. So people might say, well, it costs me $4 to produce this, I use quarts of berries, and that's going to be in the next slide. And so if I can sell it for anything over $4, I'm making a profit, right? Well, no, you're not, because we're separating out that $4 to produce, which is what the enterprise budgets coming up are going to be about, from the fixed expenses or overhead expenses. And so we're looking now at a sample income statement, and our sales are, in this case, rather large at $450,000, less the cost of goods sold. So that's the number typically coming out, or maybe not the bottom number, but one of the numbers coming out of that enterprise budget is my fertilizer, my equipment, my everything that I can specifically allocate to that crop is our cost of goods, or producing that crop. So in this case, $200,000. So our gross profit's $250,000, and then all these other expenses are overhead or operating expenses, or what we're, and I mean, if you look up in a textbook, you're going to find different definitions, but we're simplifying this. These are the fixed expenses. These are the expenses that aren't going to change whether you raise a crop or not. In this case, the manager and the accountant's expenses are there under wages, payroll tax expense, insurance, rent, advertising, utilities, depreciation. In this case, now when we get into some detailed enterprise budgets, you're going to see some utilities and depreciation there, and they can show up in both places, depending on how they're measured and how you allocate them. So now we're down to net operating profit of $115,000. We've got some interest and some taxes, and a net income of $84,800.
Barbara, this is Colette. I'm just going to jump in and say that we had a request from one of the participants. If you could explain the acronyms and abbreviations on your slides, that would be great.
That's good. Good question. Okay, so I'm going backwards here. So the costs that change proportionately to sales, often referred to as cost of goods sold, that's the COGS. So you have expenses directly incurred in sales. Examples are going to be seed, fertilizer, raw materials, inventory. If you create inventory, like cattle might be considered inventory, direct labor. And if you're a service company, let's say you're out for hire with your tractor, you might not have cost of goods sold depending on how you do your books. So the fixed costs remain the same regardless of sales levels. So some advertising. So if you've put an ad in the Yellow Pages and you have to contract that for a year ahead, regardless of whether you have a crop failure or not, you have to continue to pay for that Yellow Pages advertising. Your rent on the property, if you've signed a lease, particularly long-term, you're going to be paying that whether or not you put in a crop. Interest on your loans. Insurance, although maybe your insurance is going to get a lot higher if you hire a crew to help you with the harvest, and that insurance hopefully you can put in as, if you keep track of it well enough, put in as a variable cost, because the bigger your crop, the more that kind of help you're going to need. Okay. So again, I've got a list here of some of these expenses that might be fixed or variable. So your fuel for just, staying in operation might be a fixed expense, but your fuel for the tractor for that particular crop might be a variable expense. Okay, and I jumped ahead. So this is a simple break-even analysis, and I've used berries and quarts as the measurement that we're going to talk about. And so first we're looking at the variable costs, or the enterprise budget. And again, simplified, we're selling our berries at $10 a quart. The variable costs are $5.50 per quart. So we subtract the variable from the sales price, and we get our contribution margin of $4.50 a quart. So this is how much is contributed from each quart toward paying the fixed costs and profits. Again, we've already talked about fixed costs typically remain constant regardless of how much you sell. And so we have a list of those, and those total $1,350 a month, or $16,200 a year. So how many berries do we have to sell in order to break even? If our average price is $10 per unit and our contribution margin is $4.50 a unit, we divide the total fixed cost by that contribution margin, and we come up with 3,600 quarts per year. That's a lot of berries. And then when you sell quart 3601, you start making a profit, and that amounts to $36,000 in sales. And then there's a break-even graph here, and we see at line B, what's below that is our fixed costs, and you're going to have those even if you sell zero. That's the vertical line there. And then your variable costs, when you sell just one unit, it starts going up and up and up, and your break-even point is where they cross, that the income, and the costs below the reddish line are your total costs, fixed plus variable, and your profit is that area below income, A, and above costs, C. So some questions to ask yourself. Can you produce and sell that many quarts? And let's say you need some living expenses. You need to make a profit. And in this example, we're looking at a goal of $900 per month, or just over $10,000 per year. So how many more quarts would you need to sell in order to make that additional income? So we take the $10,800 goal divided by the contribution margin. That's the difference between the selling price and the that's the selling price minus the variable costs. So you need $2,400 more quarts to make that $900 per month profit. And then you need to ask yourself, is that feasible? How many potential customers do you have? Where are they currently buying? What are they paying now? Why would they buy from you? How many will they buy? What price would you need to start with in order to average $10 per quart? Because as they get older, you might have to discount them, or at the end of the day at the market, you might have to discount. And so then we converted this into number of quarts per day at the market. So if you're at the market for 30 days per season and you need to sell 6,000 quarts for the season in order to have your $900 a month living expenses, that's going to be an average daily sales of 200 quarts or 20 quarts per hour. Can you do that? Would you have to hire help and increase your cost to do that? And so this is one way to look at the feasibility of what you're looking at doing. And I have this reality or illusion and the gambling guy here, and I see a lot of people who are very optimistic, and I see people who make it and are very successful, and I see people who lose a lot of money in their endeavors. And so you have to judge your risk tolerance. How would your family handle this if it didn't work out like you planned? But I can tell you real quickly, if it doesn't, work in the plan, it's probably not going to work. Although I have to say, I've had people say, gosh, this looks like it's going to lose money, but I'm going to do it anyway. And they've been successful. So this is that template I was talking about earlier that's available for you to use to punch in numbers if you know a little bit about Excel and a little bit more about accounting, and possibly have the help of a consultant or somebody that does. This is a downloadable free template for punching in numbers and saying, okay, what if I need to borrow this amount of money and make these kind of payments? Am I going to be able to have enough cash flow to do it? So I have this little thing on success because that's where most of us are heading. That to find your unique strengths and interests, if you can find those, loving what you do, you work harder with more creativity and efficiency, and that gives you a powerful competitive advantage. And then a quote from Christopher Morley, and our contact information if you'd like to get a hold of us, and our websites down here. Questions?
Thank you, Barbara.
You're welcome.
At this point in time, I do not see any questions. So I think what we'll do is we can go on to Ken's presentation, and then if the other questions come in, we can come back and answer them in the later question and answer period.
Colette, this is Ken. Can you hear me?
Great.
Okay.
You sound a little bit faint, Ken.
Okay. Well, I found a microphone combination headset thing, so I didn't try that earlier. How's it sound?
I can hear you clearly. You'll have to project your voice a little bit louder.
Okay.
Great.
I'll do a sound check. Is that good?
Yes.
Okay, thank you.
That's good. And so maybe you could let everybody know where you are doing the webinar from tonight.